Wondering how to lower mortgage interest rates? As of late 2022, interest rates have risen to 7.2%, with experts predicting that they may continue to rise into 2023. These rising interest rates have many prospective home buyers and current homeowners wondering what they can do to avoid paying more on their mortgages. Luckily, there are several steps you could take and strategies you could use to potentially lower your interest rates. This is Nathan Clark with your Home Sold Guaranteed Realty here in New England. In this video, I'll list 9 strategies for lowering mortgage interest rates. If you'd like more real estate tips like this, check us out at nathanclarkteam.com. And don't forget to like and subscribe below. It helps me out a lot. Now, let's get started. First, visit multiple lenders. The easiest way to get lower interest rates on your home loan is by visiting multiple lenders. You know, I tell a lot of buyers out there, you wouldn't walk into the first house you look at and buy it. You look at a lot of houses, whether even just online or physically, because you're going to be living with that house for a while. Well, you need to look at your mortgage the same way. You wouldn't want to buy the first mortgage rate or first mortgage offer you've got. You'd want to shop around, because just like your home you're going to have for a while, your mortgage you're going to have for a while also. So you want to make sure you get the best rate. So make sure you shop around. Number 2 is improve your financial situation. A good credit score can go a long way towards getting you a home loan with a lower rate. Simple acts like paying down your credit balance, making payments on time, and not taking out new lines of credit right before your mortgage can improve your chances of getting a more favorable rate from lenders. Another factor lenders look at is the stability of your income. Lenders like to see what you've been doing, what you've been making, and for how long and how many years you've been in there. If they see a lot of you jumping around from job to job, they want to see some stability there, and that sometimes makes them a little leery about your credibility, and any changes on employment can actually cancel any mortgage application that you've been doing, and they'll deny you for it. So looking for a lot of consistency in the same field. Number 3 is look at adjustable rate mortgages versus fixed rates. Generally, when interest rates are high, adjustable mortgages are a better option because they have low interest rates that are fixed for initial period. If you could pay your mortgage off during this initial fixed period, or you believe maybe you'll get a raise in the future, you'll have more income, things get paid off, okay, to help you avoid really paying a higher rate right now. But however, once the initial period ends, you'll be paying whatever the going rate is. One of the good things that you can look at with an adjustable rate mortgage, though, maybe a 5-year or 7-year lock, is it's locked in for that period of 5 to 7 years. Most home buyers are in a property for 6 years or less, where, especially if you're a first-time home buyer, you're probably going to trade up to something bigger in the future. And if you have an adjustable rate mortgage that ends in 7 years, but you move in 5 or 6 years, then you're covered. The danger, though, is if you don't sell in 5 or 6 years, interest rate went even higher, you're going to even have a higher rate when that comes up there. So it really is a gamble that a lot of people do in these markets, hoping to refinance maybe 2 or 3 years down the line. I've seen a lot of people be very successful with it. I've seen people roll the dice and not win there, but it is an option. Number 4 is purchasing mortgage points. You know, at the closing table, home buyers have the option to purchase mortgage points. These points are essentially a fee to lower your mortgage rate. 1 point is equivalent to 1% of the loan's value. And for every point you buy, it lowers your interest rates by a certain percentage. If you have the ability to afford points, it could save you money in the long run. This is particularly the case if you plan on staying in the home long enough to recoup the cost of the points. But once again, make sure you're doing the math to make sure you're not just buying the rate down to sell the house in 5 or 6 years. It's a long-term play. Number 5 is consider a short-term loan. Another option for avoiding high interest rates is taking out a shorter-term loan. Shorter-term loans are less risky for the lender, so they come with lower interest rates. However, the trade-off is that you'll be making higher monthly payments. Number 6 is lock in your rate. Prospective homebuyers should consider asking their lenders about locking in the interest rate. This is a good move if you expect interest rates to go up, though it can also end up hurting you if rates end up going back down. To lock your rate, you'll likely have to pay your lender a fee, and it's also possible to negotiate a rate lock that allows you to take advantage of lower interest rates. Most loans do come with a loan lock rate while you're looking at houses. Some are 45 days, 60 days. You want to make sure you talk to your lender to let them know how long that rate is locked for when you apply. Number 7 here is put a larger amount of money down. If you're wondering how to lower mortgage interest rates, one of the most obvious ways is to make a larger down payment. Since interest rates are calculated based on the principal amount, you'll end up paying a lower rate overall. And most of the times, if you're putting more money down, you're less risk to the bank. So they usually give you a better rate versus if you had a no money down loan or just a couple of percent down. Number 8 is sign up for automatic payments. Another way to make yourself more favorable to lenders is by signing up for automatic payments for your mortgage payment. Depending on the lender, they may offer you a low interest rate if you incentivize them by letting them take the money automatically every month from your bank. So check that out. Make sure you look at that when you're signing up on your mortgages. And number 9, last here, is refinance your existing mortgage. For current homeowners, refinance is one of the most common ways to lower mortgage rates. If you currently have a fixed rate mortgage, consider refinance to an adjustable rate mortgage, or vice versa. You can also refinance the same type of mortgage, just with more favorable terms. Or if your credit score and income have improved since you first looked at your mortgage, you could try asking a lender for a lower rate on the basis of increased financial stability. So despite rising interest rates, there are certain steps that you can take to lower your mortgage rates as much as possible. This all starts by working with a professional realtor in your area. An experienced realtor can connect you to the best lender so you can find the right mortgage for your financial situation. If you'd like more information on navigating rising interest rates, or learn more about working with our team to buy or sell real estate here in Rhode Island and New England, feel free to give me a call at 401-288-3557 or visit nathanclarkteam.com. I'm Nathan Clark, and don't forget to hit that subscribe button below, and thanks for watching.